What we do here is go back.
Committee will come to order. Today, the committee will turn its focus to facilitating faster payments in the United States. Faster payments are important and yield economic benefits for both consumers and businesses by providing them with greater flexibility when managing money and making time-sensitive payments on demand. Real-time payments offer efficiency and convenience, helping consumers to better manage their spending and avoid unnecessary fees and penalties, and helping businesses pay for goods and avoid other costly sources of funding. Unfortunately, the U.S. has lagged behind other countries in the development of real-time, faster payments for retail. Recognizing this shortcoming, in 2015, the Federal Reserve organized a Faster Payments Task Force made up of a diverse group of stakeholders to encourage the development of a real-time payment system in the United States. The Fed stated in its report on strategies for improving the U.S. payment system that it would not consider expanding its service provider role unless it determines that doing so is necessary to bring about significant improvements to the payment system, and that actions of the private sector alone will not achieve the desired outcomes for speed, efficiency, and safety in a timely manner. Responding to the mission of the Faster Payments Task Force, the Clearing House announced in 2016 its intent to launch a real-time payment system, which it officially launched in November 2017. Just prior to the Clearing House launching that system, the Faster Payments Task Force in July of 2017 issued a final report, which offered several recommendations for achieving a safe, ubiquitous, and efficient faster payment system in the United States. One of these recommendations was for the Federal Reserve to develop its own 24/7 by 365 real-time gross settlement system for retail payments, and to assess whether there were other operational roles the Fed should play in faster payments. After determining the Federal Reserve banks should develop a new real-time gross settlement service on August 2, 2019, the Federal Reserve Board voted on the Fed's proposal. The lone dissenter was Vice Chairman for Supervision Randy Quarles. The Federal Reserve then issued a notice and request for comment on the Federal Reserve actions to support interbank settlement of faster payments, a system referred to as FedNow. In Vice Chairman Quarles' dissent, he noted that the U.S. private sector has a long history of providing efficient payment solutions to consumers and businesses. He added that the public sector should provide its own capacity only when the evidence of market failure is clear and alternative means to achieve public goals are not feasible. He added that he does not see a strong justification for the Federal Reserve to move into this area and crowd out innovation when viable private sector alternatives are available. Additionally, when providing a new payment service, the Federal Reserve is required to meet certain obligations and criteria before moving forward. Those criteria are: the Federal Reserve must expect that its providing the service will yield a clear public benefit. The service should be one that other providers alone cannot be expected to provide with reasonable effectiveness, scope, and equity. And the Federal Reserve must expect to achieve full recovery of costs over the long run. Throughout the Fed's process, some financial institutions have raised concerns about the Fed's analysis and its process, the cost and amount of time it would take to develop its own real-time payment system, its prospects for achieving interoperability, inherent conflicts of the Fed operating its own system, and prospects for negatively affecting existing real-time payment systems. Still, other financial institutions urged the Fed to move forward due to their concerns surrounding pricing, power, and competition in the marketplace. I strongly support better, safer, and faster payments in the U.S., including the work already done on existing solutions in the private market. I look forward to learning more about the numerous issues during this hearing, including clear demonstration of the market failure or problem that the Fed believes it must solve through the development of its own real-time payment system, how the existing real-time payments platform works, how it has been impacted by the Fed so far, and the consequences of the Fed developing a competing system, and how the Fed believes its proposed system could achieve interoperability, minimize negative effects to existing private sector participants, and fully recover its costs quickly. I look forward to hearing from each of you on your views on these payments in the U.S. and more about the existing proposed platforms. Senator Brown.
Thank you, Mr. Chairman. Thank you to the very distinguished panel with us today. Whether it's Facebook thinking it can run its own currency or big banks wanting a monopoly over our payment system, we can't allow corporations to take over critical public infrastructure so they can squeeze more profits out of working families. Whether you punch a clock or swipe a badge, every working American knows how important payday is. It's often the day you know you can pay your bills and make rent, but sometimes payday doesn't line up with the day your bills are due. If that means a delay in paying the bills, banks will pile on late fees and overdraft charges, so it's even harder for people to make ends meet. Recently, the Federal Reserve Board announced it will develop a system to provide payments in real time. This is great news for millions of Americans who live paycheck to paycheck, for anyone who's waited for a check to clear or had to resort to a payday lender on Friday to tide them over until Monday. Faster payments allow Americans to actually use more of the money they've already earned. But while some of us see a problem to solve for working families, the biggest Wall Street and foreign banks see opportunity. They see what they always do, and that's dollar signs. They see another way to squeeze more profits out of the rest of us. That's why they don't want the Fed to be involved. They built their own real-time payment system on top of existing Federal Reserve infrastructure. But we really don't know how it's governed, how much it will cost, how they plan to skim more profits off the top. We can't trust that the big banks won't charge more to community banks and credit unions. They've already changed their mind on their prices once. There's no guarantee they won't change their minds again. Big banks oppose the Fed's effort because they want to be the only game in town. We know what happens when we trust Wall Street. 11 years ago this month, Lehman Brothers failed, sparking the worst financial crisis since the Great Depression. Many of the big banks now asking for this monopoly over the real-time payment system are the same Wall Street banks that wrecked our financial system and came begging for billions of dollars in taxpayer money to save them. They haven't exactly cleaned up their act. These same banks, like Wells Fargo, Bank of America, and the president's favorite, Deutsche Bank, have been involved in scandal after scandal, creating fake accounts for customers, illegally foreclosing on service members' homes, violating U.S. sanction laws, on and on and on. It seems like there's a new scandal every day. Capital One just suffered a huge data breach, exposing millions of customers' personal data. Remember those overdraft fees and late fees and transfer fees that we're trying to protect workers from? It's these same big banks that slap on these fees. They create the problem, now they want to charge people to solve it. To make matters worse, the administration is rolling back the safeguards that we put in place to protect working families from the risky Wall Street activities that crashed our economy. It was another financial crisis over 100 years ago that led us to create the Federal Reserve to clear payments and govern our currency. Congress recognized the high fees and abuses going on in our payment system and understood that we needed a publicly run central bank to provide financial stability and fair access to the payment system. In the words of Representative Glass, later to be the Senator Glass of Glass-Steagall, they sought to tear down these toll gates upon the highways of commerce. That's how we should think about the payment system, as the highways of commerce that support every dollar that fuels our economy. Just like roads and bridges, the payment system is critical public infrastructure, something that everyone should be able to use. We can't let profit-motivated big banks whose mission is to serve shareholders, not ordinary Americans. We can't let them have a monopoly over it. This committee's heard a lot this year about big corporations taking advantage of us through the smokescreen of new technology and innovation. In our data privacy hearings, we heard about big tech companies and financial firms manipulating us into sharing our personal data so they can profit. In our hearing, Facebook dodged our questions about its plan to run its own digital currency out of a Swiss bank account, showing yet again that we can't trust them. We can't allow big corporations to take over critical public infrastructure. You would think we should know that by now. The largest banks and tech companies are not acting in the interest of working Americans. Their interest is to earn a profit for themselves and their investors. I understand that. But the Fed's interest is not to make a profit. It's to make sure that all people can pay their bills on time and transfer money when they need it, whether they live in rural America or in a metro area. The Fed's real-time payment system will benefit working families and small banks and credit unions, small businesses, the public as a whole. Everyone except Wall Street agrees. Thank you, Mr. Chairman.
Thank you, Senator Brown. Today's witnesses are Ms. Esther George, President and Chief Executive Officer of the Federal Reserve Bank of Kansas; Mr. Robert Hunter, Executive Managing Director and Deputy General Counsel of the Clearinghouse; Mr. Bob Steen, President and Chief Executive Officer of Bridge Community Bank on behalf of the Independent Community Bankers of America. Mr. George Selgin, Senior Fellow and Director of Cato Institute, and the Honorable Sheila Bair, former Chair of the Federal Deposit Insurance Corporation. Again, I want to thank all of our witnesses for being here and sharing with us your expertise today. Your written testimony has been entered into the record. We will take your testimony in the order I introduced you, and you may start. Ms. George.
Chairman Crapo, Ranking Member Brown, and members of the committee, thank you for this opportunity. Chair Powell has asked me to speak to you today in my role as the Federal Reserve Bank leader responsible for our Payments Improvement Initiative since its beginning, and as chair of the Financial Services Policy Committee, which oversees the provision of payment services to depository institutions and the United States Treasury by the 12 Federal Reserve banks. I'm pleased to offer my statement for the record, as well as an in-depth statement on the role of the Federal Reserve in the payment system and the recently announced proposal to support faster payments through the development of a new service called the FedNow service. Since the Federal Reserve's founding more than a century ago, it has provided payment and settlement services as part of its core function of promoting an accessible, safe, and efficient payment system. Today, the Federal Reserve is continuing this important operational role and preparing to support the modernization of our nation's payment system with capabilities that allow payments to move quickly through a safe and efficient foundation, on top of which innovation and competition can flourish. This decision was made only after 3 criteria were met. The first of these criteria is that other providers alone cannot be expected to provide the service with reasonable effectiveness, scope, and equity. Of notable importance related to this criterion is the Federal Reserve's ability to connect to more than 10,000 financial institutions. Through these connections, our existing payment services allow banks of every size to serve the needs of thousands of communities across the United States with competitive, fair, and transparent access. Providing comprehensive nationwide reach is something that we believe will present significant challenges to other providers in the current market landscape. Coming from a region of the country with a significant number of small community banks serving rural areas of the central United States, I can tell you the board's decision to provide this new service has been very well received. The second criterion is that there will be a clear public benefit, including promoting the integrity of the payment system and reducing payment system risk. The Federal Reserve must continue to play an important role in promoting the safety of the U.S. payment system by providing liquidity and operational continuity in response to financial turmoil, terrorist attacks, natural disasters, and other crises. The FedNow service will allow the Federal Reserve to retain its ability to provide stability and support to the banking system, as well as promote the development and implementation of industry-wide fraud mitigation standards. Development of the service will also enhance safety of the U.S. payment system by promoting resiliency through redundancy. The third and final criterion is that the Fed be able to fully recover its cost over the long run. The U.S. payments infrastructure today includes alternative payment choices and providers. The Federal Reserve and the Clearinghouse currently operate competing and interoperable services, which bring important benefits for resiliency and competition. In all of our services, we have been able to meet the requirements of the Monetary Control Act for cost recovery that ensures competitive fairness while fulfilling our public policy goals. We fully expect this will be the case with the FedNow service. As was explained in a 2016 GAO study, the Federal Reserve's role as an operator has long been judged as effective in promoting accessibility, safety, and efficiency for the nation's payment system and its customers. Last summer, the U.S. Treasury recommended that the Federal Reserve move quickly to facilitate a faster retail payment system. We are engaging now with stakeholders for their input on features of the FedNow service through the Federal Register notice issued last month, and I'm confident that together we can achieve our public policy objectives for broadly accessible, safe, and efficient faster payments. Thank you. I'm happy to respond to your questions.
Thank you. Mr. Hunter.
Chairman Crapo, Ranking Member Brown, and distinguished members of the committee, my name is Rob Hunter, and I'm the Deputy General Counsel of the Clearinghouse based in our North Carolina facility. I've worked at the Clearinghouse for more than 10 years, providing senior legal support to our payment systems, including our focus today, the RTP network, which I was privileged to be involved in developing. I'm also the past chair of the Subcommittee on Electronic Payments of the American Bar Association and have been involved in payments throughout my career. The RTP network is a new and exciting part of our national payment infrastructure. It was launched in 2017 by the Clearinghouse, is fully operational, and today reaches over 50% of the transaction accounts in the U.S. One of the most distinguishing features of the RTP network is that it operates in real time and all the time. There are no banker's hours. It functions 24/7. The RTP network also delivers on the vision of faster, more efficient, and more secure payments that will benefit every American consumer and business. This innovation is consistent with the Clearinghouse's long history of providing core payments infrastructure that is efficient, safe, and reliable. Founded in 1853, for over a century and a half, the Clearinghouse has served as the leading private sector operator of payments infrastructure in the United States. On an average business day, the Clearinghouse clears and settles nearly $2 trillion over its wire transfer, automated clearinghouse, and check clearing networks. Created to provide the payment services required by the nation's economy, the Clearinghouse exists to serve depository institutions of all sizes. In fact, more than 80% of the participants in our ACH and check clearing services are institutions under $10 billion in assets. The Clearinghouse prices its services on a cost recovery basis, and there is no special pricing for owner banks. The Clearinghouse also has a remarkable history of operational resiliency, clearing and settling payments every day without fail through world wars, financial crises, and natural and man-made disasters, including 9/11 and the Great Recession. This morning, I'd like to briefly focus on the committee's request that I describe the RTP network, and in doing so, will focus on the Fed's Faster Payments Task Force as well as touch on FedNow. My written comments expand on these topics as well as other questions posed in your invitation letter. The payments landscape in the United States is highly competitive. Although there has been tremendous innovation in end-user products during the last decade, what has been lacking is modernization of what we often refer to as the payments rails that undergird the system. The Federal Reserve recognized the need for faster payments, used its convening power to urge the private sector to make real-time payments a reality, and established a Faster Payments Task Force. Not only did the industry respond by designing, building, and bringing to market the RTP network, investing over $1 billion to do so, but according to the ratings it received from the task force, it did so extremely well. Of the 16 different private sector proposals submitted to the task force, the RTP network was rated the highest, including in such key areas as accessibility and path to ubiquity or nationwide reach. As I speak to you today, the RTP network is operating, delivering the real-time capabilities that Americans want and need. Payment recipients receive final good funds immediately, and payment senders receive real-time confirmation that the funds have been received. The benefits to consumers, small businesses, and the nation's economy are transformational. The committee has requested our views on the Fed's decision to enter the real-time payments market. As provided in my written testimony, the Clearinghouse is concerned that the Fed's actions may hinder the Clearinghouse in achieving the full potential of the RTP network. When the Fed competes with the private sector, it must do so in a manner that minimizes the competitive advantages that a government system would have, both inherently and as a direct byproduct of the Fed's role as supervisor, the supplier of liquidity to the financial system, and the central bank. This is not the usual competitive question of impact on profitability, because the Clearinghouse does not seek to operate at a profit. Rather, it is a question of the Clearinghouse's ability to provide the most effective and efficient real-time payment system to consumers and businesses to the ultimate benefit of the overall economy. To help the Clearinghouse achieve this objective, we believe there are several actions that the Fed could take now before launching its FedNow service that would help to create competitive equality between the private sector and the government. These are detailed in my written statement. In conclusion, the Clearinghouse RTP network is the most advanced payment system in the world, and we are working hard to extend its benefits to banks and credit unions of all sizes, so consumers and businesses across America can realize the benefits of faster, more efficient, and more secure real-time payments. We appreciate your interest in this topic, and I look forward to answering your questions.
Thank you. Mr. Steen.
Chairman Crapo, Ranking Member Brown, members of the committee, I'm Bob Steen, Chairman and CEO of Bridge Community Bank in Mount Vernon, Iowa. I testify today on behalf of the Independent Community Bankers of America, where I have played an active role over the years, including service on the Payment Committee. Thank you for the opportunity to testify today. I believe it is imperative that the U.S. develop a robust real-time payment system to meet consumer and business demand and stay competitive with the rest of the world. This system must create access for customers of all financial institutions and regardless of size in every American community. How we achieve this goal is critical. A real-time payment system is too important to be entrusted to a private monopoly. The 24 largest banks simply cannot own and operate the U.S. payment system. ICBA strongly supports the Federal Reserve's decision to build FedNow, a real-time payment system that will give direct access to all financial institutions and their customers. Bridge Community Bank is a $96 million community bank founded in 1903 and is owned by our 20 employees. We serve rural communities and growth markets in and around Cedar Rapids and Iowa City with small business, agriculture, and consumer banking. Our business model is relationship banking, in which we serve the totality of a family's business and personal banking needs, both deposits and lending. The transaction account is the key to the customer relationship, and it is at the heart of community banking. We have long recognized that the payment innovation is critical to the long-term prosperity and independence of our bank and community banking. This is why I've invested so much of my career in payments innovation and developed multiple payment projects in our small bank. Only the Fed can guarantee competition and choice. The U.S. does not need another closed-loop payment system in which some financial institutions participate and others are excluded. All financial institutions and all customers must have access to real-time payments, even those that live in small and rural communities exclusively served by community banks. I firmly believe this simply cannot happen without the Fed's role in real-time settlement. The Fed is uniquely positioned to provide access to all 11,000 financial institutions because these institutions have access to a settlement account and a service connection with the Fed. The Fed already operates a universally accessible check, ACH, and wire transfer service. If history is any guide, the Fed will maintain affordable as well as universal access to faster payments. The Fed offers a fair and affordable pricing structure today, even to the smallest of the small financial institutions like our small bank. The Fed is trusted among community banks. Each community bank has a relationship manager and the opportunity for direct access to the payment system. I know our representative's name, I know his cell number, and he answers the phone. As a community bank, I know that I have direct and easy access to Fed support services even after our banking hours, and I place a high volume on that access. As I stated at the outset, payments innovation, offering customers what they want when they want it, is critical to the prosperity and continued independence of our community banks. As a neutral real-time settlement network, FedNow will be critical in our ability to continue to innovate. For example, my bank, in partnership with another community bank, developed a mobile app called XCheck, which allows a user to send money to anyone in the U.S. that has an account at any other financial institution without a payment application on the receiver's mobile device. Once FedNow is fully operational, XCheck will allow real-time transactions without being dependent on our core banking. That by itself is transformational. Once ubiquity is achieved through FedNow, new use cases and opportunities for innovation will emerge. The Fed's entry into real-time payments is part of a natural evolution from its involvement in check clearing, ACH payments, and wire transfers. The Fed has strengthened the payment system by providing safety, integrity, choice, and equitable access to all financial institutions. I'm confident the Fed will bring the same critical benefits to real-time payments. Thank you again for convening the hearing, and I will try to answer any questions.
Thank you. Mr. Selgin.
Thank you, Chairman Crapo, Ranking Member Brown, and distinguished committee members. I'm the director of Cato's Center for Monetary and Financial Alternatives, but before I came to Cato, I was for 30 years an academic economist specializing in monetary and payments theory and history. The slow pace of payments in this country is a disgrace that's taking a large toll on U.S. citizens and particularly on those who live paycheck to paycheck. So I very much appreciate this opportunity to address you and offer suggestions for helping to speed payments up in this country. I particularly want to discuss steps that Congress might take to assure that outcome. The Fed claims that the best way to solve the problem of expediting payments is for it to compete directly with existing retail payments networks and RTP, the Clearinghouse Fast Payment System, by establishing its own fast payment system, FedNow. And competition from the Fed certainly could help to promote faster payments, but it only will do so if the Fed competes on an even or level playing field with existing private sector service providers. However, the Fed enjoys many very special privileges that can allow it to slant the playing field in its favor. And when it does that, the outcome can be not to facilitate the achievement of faster payments, but to hinder its achievement. I want to talk about several ways in which the Fed can slant the playing field in its favor that can harm progress toward faster payments. One of them is by failing to offer 24/7, 365 interbank settlement services. You have heard before, and you heard from Senator Brown, how many persons live paycheck to paycheck, and when their checks don't clear quickly or their payments don't clear quickly, they may wait days in order for funds to be made available to them, and many resort to payday lenders for that reason. Real-time payments can, of course, help solve that problem, real-time retail payments, but actually they're not necessary. Those workers would benefit just from having payments available on the same day, that is, having funds released on the same day. The problem they face isn't that their funds aren't released instantly, it's that they take several days sometimes to be released. Now, why is that? It's not because we don't have a real-time payment system. It's because the Fed's own net settlement services, FedWire and the National Settlement Service, don't operate on weekends, don't operate on holidays. Now, the Fed has known about this problem and has talked about fixing it for years, and NACHA has encouraged it to do so, but it has been dragging its feet. And that means that it's making it harder for existing payment systems to compete effectively with it. I asked Congress to take the crucial step of making sure that the Fed fixes this problem. By the way, when it decided to launch FedNow, it amazingly decided not to proceed with 24/7 settlement services on its existing networks. And there's no excuse for that, because the support for that reform is unanimous. A second point, in my written testimony I talk about 4, concerns the pricing of settlement of payment services, faster payment services. You've all been told that the Fed needs to compete because it's worried that the clearinghouse will abuse its monopoly. In fact, the facts are otherwise. The clearinghouse, as it said, and I know this from studying its history, doesn't charge in order to make profits. It's providing a service to its members through the payment facilities it administers for them. It doesn't pay dividends, and this has been true throughout its history. It's verifiable. The problem is that the Fed can charge volume discounts, and the TCH is planning to charge flat fees. Now, why does the TCH want to allow itself to go to volume discounts if it needs to? It's because in competing with the Fed in ACH services, it found the Fed resorted to steep volume fees in the 90s, and it had to follow suit. The only reason it has a loophole in its pricing policy is that the Fed might resort to volume payments itself. Congress can prevent the Fed from doing that by making it make the same commitment to flat fees that are equitable to small banks as the clearinghouse has made. I'll stop there. There's more in my testimony along the same lines. Thank you.
Thank you. Sheila.
Mr. Chairman, members of the committee, thank you so much. It's been a while since I've been before this committee. It's nice to be back. I'm here in a personal capacity as someone who has spent most of my career in financial services, most of that time as a regulator, and as you know, who led the FDIC during the financial crisis. And I saw firsthand how concentrations of financial power and a handful of so-called too-big-to-fail institutions almost ran our economy into a ditch and forced trillions of dollars in government support. To be sure, mega banks are safer now, but I don't think they're safe enough. And post-crisis reforms have been untested so far. We don't know how well they're going to work. And even now, they're subject to unrelenting challenge by industry groups, including I might add, TCH. The sector remains heavily concentrated. Over half of deposits are in the largest 15 institutions, and nearly half of all assets are concentrated in the top 5. Given the continued dominance of mega banks in our financial system, do we also really want to cede to them control of the infrastructure supporting the next generation of payment services? You'll be hearing competing arguments today about whether FedNow will promote or hinder competition, whether it will foster or inhibit innovation to meet demand for real-time payments, whether it will broaden access and equitable pricing or result in additional unnecessary costs. In evaluating these arguments, I hope we can all apply some basic common sense. Which kind of payment infrastructure is more likely to promote competition? A single system controlled by an entity that's owned by already dominant for-profit banks, or one that is supported by 2 parallel systems, one of which is operated by a government agency whose mandate is to ensure equity and fairness in the provision of payment services? Which payments infrastructure would better promote innovation? One dominated by a single monopoly, or one resting on 2 systems from which financial institutions and their fintech partners can choose in offering their customer-facing platforms and services? Which payments infrastructure is most likely to promote resiliency? One solely reliant on the stability and operational integrity of large banks, behemoths which still operate with high levels of leverage and have failed in the past in times of stress, or one that can also rely on a system operated by a government entity like the Fed, with a proven track record of success in managing through the most distressed of economic conditions? And finally, which payments infrastructure is most likely to achieve ubiquity in reach and access among all depository institutions, regardless of size or geographic location? One run by an organization whose owners are heavily located in East Coast urban areas, or one which includes a second system like the Fed that has pre-existing trust relationships with virtually every depository institution in the country? Some have tried to portray the Fed as a bureaucratic heavy interfering with private sector innovations to provide real-time payments, motivated not by public interest, but self-interest in preserving their power in the payment system. I frankly think that's nonsense. The truth is that the Fed has taken a measured, deliberative approach to whether they should build their own real-time interbank settlement system. They have waited for private sector. They have let the private sector try to innovate to meet market demand for faster payments, and indeed the U.S. has fallen behind. So while I congratulate TCH on developing the RTP system, the truth is it has not gained significant traction, and the overwhelming majority of public commenters who the Fed solicited support the Fed building its own system. The Fed has worked hard to support TCH's efforts. It's not that the TCH RTP system is going to go away, and they're committed to using a process in building FedNow that will incorporate the views of TCH and others, and hopefully eventually achieve interoperability. But again, the Fed is determined based on a consensus that pretty much includes everyone other than the big banks, that their operational participation is required to ensure a next-generation payment system that is ubiquitous, fair, inclusive, and resilient. We saw in 2008 what happens when a handful of very large institutions are allowed to dominate basic financial infrastructure. And I, for one, never again want to see a gun placed against the head of taxpayers, bail the banks out, or watch your economy go down. 2008 was bad enough. I shudder to think if those same banks had sole control of our payment system of the future. When it comes to payments infrastructure, 2 is definitely better than 1. I think the Fed is right to step in, and I hope that the Congress will support them. Thank you.
Thank you. I'm going to focus my questions on Ms. George and Mr. Hunter, and just ask you each to respond to the concerns that have been raised by those who are worried about your particular approach. For example, Ms. George, first, what do you say to those who say that the Fed has an unfair advantage and would actually operate from an unbalanced playing field in a way that would reduce the effectiveness of both payment systems.
So I would point to the Federal Reserve's history in operating payment services across a variety of rails. There has been no instance when the Federal Reserve has not operated alongside with the private sector and have been very transparent in meeting the requirements that we offer competitive and transparent pricing on our transactions. That history was confirmed with a GAO report which looked at this very issue of what the Fed's role has been, what has happened to innovation in the economy, consumer prices related to those payment services, and concluded that the Fed's role has been beneficial in operating in that space. So the history would support our intent, even with this new Fed service, to continue in that tradition.
All right, thank you. And Mr. Hunter, what do you say to those who indicate that they don't understand why there would be a concern about having a competitive alternative in the payment system?
Thank you, Mr. Chairman. We are not against competition in the payment system, but if there is going to be competition in the payment system between us and the Fed, we want to make sure that that's a level playing field between the private sector and the government. There are two particular issues that the Fed could address to ensure that there is a level playing field between the private sector and the government. One is, was briefly touched upon by Mr. Selgin. The Fed has architected FedNow, what little we know about it, to effectuate settlement through master accounts at the Federal Reserve, which only the Fed can offer. Those accounts count towards reserve balances and they bear interest. The Fed could accord the same treatment to the RTP account that we use for settlement that is sitting at the Federal Reserve Bank of New York. So that's one issue. The other issue deals with the potential liquidity that's needed by the system on nights and weekends. The Federal Reserve has indicated that it's architecting its system so that the system itself will not enforce net debit caps on nights and weekends when the Federal Reserve Fedwire service is not available and NSS is not available. That can put banks in credit positions. It is an architecture that frankly, the Federal Reserve, under the requirements that we have for establishing the account, is not available to us. We wouldn't probably do it anyway because we consider it unsafe and unsound for banks to get into large credit positions or potentially large credit positions during times when Fedwire and NSS are not available. As Mr. Selgin noted, the one recommendation that came out of the Faster Payments Task Force that was unequivocal and upon which everyone agreed in the comment letter process was for the Fed to extend the operating hours for Fedwire and NSS. It is the single most important thing that the Fed can do to encourage private sector competition, and we would urge the Fed to do that. In addition to that, we are committed to level pricing for banks of all sizes. We've made that commitment publicly. We understand the history of the ACH where we had a level pricing structure, but the Fed came in and offered steep volume discounts in order to try to lure banks away from the clearinghouse's ACH service. That's the source of the caveat that we've made, and we've wanted to be transparent with the market and indicate that we are committed to a level pricing structure, whether you're the JP Morgan Chase or you're the little bank of Oak Ridge, North Carolina, where I live, you'll pay exactly the same. But I think we need a commitment from the Federal Reserve to engage in that same level pricing structure so that community banks and banks of all sizes can pay the same amount regardless of the service.
All right, thank you, Senator Brown.
Thanks, Chairman. Mr. Hunter, thank you for those last comments. Your website says the clearinghouse is owned by 25, quote, of the world's largest commercial banks. As we all know painfully, 10 years ago, a lot of those banks needed to be rescued by taxpayers. Do you know how much taxpayer money your member banks needed to stay afloat?
I do not, Ranking Member Brown, but I will tell you there is one sector of the economy that functioned flawlessly throughout the financial crisis,
I know what
and
your
it's
answer
the clearing and settlement.
The answer to my question is $194 billion. And to think that you then want a monopoly on the payment system is just doesn't seem wise. President George, let me start with you. Thanks for your work on this question. Does part of the Fed's proposal specifically benefit the clearinghouse's real-time payment system?
At the start of our work on looking at faster payments, we were very interested in making sure the private sector was able to participate in this effort and created a special account that would allow for them to operate their real-time payment system.
So logically, then, it's fair to say the clearinghouse wants the Fed to support real-time payments, but only in a way that helps their private payment systems owned by the big banks.
We have worked alongside the clearinghouse in many payment services, and it would be unusual for us not to work alongside them, even in this new rail.
Okay. Ms. Barron, sorry I missed the beginning of your statement. I heard people describe it behind me. I'm in and out of I apologize. I don't usually do this, but we're doing an Agent Orange and Burn Pit hearing that I asked Chairman Isaacson to hold, and so I need to return. But so I apologize. As FDIC chair during the crisis, you saw firsthand the big bank failures and the havoc they wreaked on our financial system and economy. How does the concentration of critical public infrastructure, and that's what this is, in the hands of the biggest banks, pose a risk to our economy? What would happen to small banks, and what would happen to working families during a crisis if large banks controlled the payment system?
Well, I think, first of all, I'd like to say that if you count all government support, including FDIC debt guarantees and Fed lending, we're well into the trillions. The taxpayer number was one you cited, but it was quite a massive...
Being conservative.
Yes, being very conservative. Look, I think you have centralization of risk. You have a single point of failure. You have operational risk with just having one system. You also have the system is backed by joint accounts, which are funded by these large banks. So if one of the or more of the large banks can no longer fund into the joint account, we don't know what will happen. I think eventually, if there's a disruption if we have this monopoly payments provider, and there's a disruption, the Fed's going to have to come in anyway, and it'll probably be a lot less efficient and costly and potentially disruptive for they have to take 2 or 3 steps to come in to support and bail out the monopoly system that the large banks are running. So we need 2 systems. Nobody's saying that we shouldn't have RTP. That's fine, but we need 2 systems. And it's much more, I think, the public confidence, the equity issues in terms of the Fed's willingness to work with all parties and be accessible and price fairly with all parties is also a significant policy benefit of having 2 systems.
Okay, thank you. Mr. Steen, thank you for being here. I admire that you run an employee-owned bank where workers have a stake in the company. Thank you for that. With increasing consolidation in the industry and the growing number of non-banks and fintechs engaged in traditional banking, it seems to be getting harder for community banks to compete. Why is the Fed's decision to operate a faster payment system so critical for community banks like yours, employee-owned, but obviously other community banks as part of the ICBA?
Well, Senator, thank you. As I indicated in my statement, we believe that transaction accounts are the basic core relationship with our customers, and we believe we have to provide them the technology and the faster payment that they need. Many of our customers do need money sooner than they're getting it today. We provide availability as early as we possibly can. On Thursday night at midnight, they get their Friday pay. We do everything we can do to get them the money. But we can make it better, and we believe FedNow will do that.
Thank you to all of you.
Thank you. Senator Moran.
Mr. Chairman, thank you. Thank you for hosting this hearing, you and the ranking member. When you introduced Ms. George, you introduced her as the President and CEO of the Federal Reserve Bank of Kansas, and I appreciate your thriftiness in choice of words. And I also would like to pay tribute to Ms. Baer, a highly respected Kansan, a native, and who is highly regarded. She had the benefit of working for a highly regarded senator, and I appreciate your work throughout your life. Let me start with Ms. George. Generally, I would say in Kansas, this proposal is popular with Kansas bankers. The interoperability is important in addition to prompt payment. And I want to see if you can assure me that whether a bank chooses FedNow or the RTP system to provide those faster payments, that their business will flow to any institution in either network. Today, both institutions run retail and wholesale payment services that are inoperable. Is the Fed committed and confident that it'll be able to continue the same with these faster payments?
Senator Moran, having interoperability will be a desirable outcome of this effort. We are focused on gaining nationwide reach. We think it's important that every financial institution gain access to real-time payment services. And then we can begin, as we design this system, to look at what the nature of interoperability will be. We are out now for comment, asking for features and design, and we'll be including interoperability and getting feedback on how that would work today relative to how it works with our other payment services.
Mr. Hunter, how do you see this issue?
Thank you, Senator. I appreciate the question. We do not envision that the systems will be interoperable. Real-time payments are fundamentally different in terms of how they work than the ACH or the wire transfer system. And if you look at Europe, for example, where the central bank came out with its own real-time payment system, it is not interoperable with TIPS, which is the private sector's real-time payment system. In real-time payment system, clearing, which is the transmission of the payment message, happens alongside settlement. They are not bifurcated at all. They happen at the same time and they happen instantaneously. So from the time I hit send to send you money, Senator Moran, to the time that money is in your account and you've got access to it is literally milliseconds. Because of that architecture, which is architected in the way that the Federal Reserve's Faster Payments Task Force sort of set out the criteria, it wanted a real-time payment system, you can't bifurcate those processes. So it's not like the ACH, which is interoperable for transmission of the message only, but settlement happens at a later time. Because clearing and settlement, transmission of the message, and final payment happen immediately, those two things aren't separated. And you can't interoperate in that regard. Both the sending bank and the receiving bank have to be on the same system. They have to be able to talk to each other instantaneously, and they have to work in such a way that those funds are transferred and available immediately. So we are not optimistic that these two systems will be interoperable.
Thank you for your comments. Again, Ms. George, Mr. Seljan's comments about holidays, weekends, and 24/7 caught my attention. What is the Fed response in that regard?
So a real-time payment system will be operating 24/7 by 365, and that will include holidays and weekends. The question that Mr. Seljan raised is one of how expanding hours for funds transfer might facilitate the private sector service in providing real-time payments. Because that is a systemically important system, we will have to look and do the operational analysis on what it means to provide that kind of real-time expanded hours. And we have committed to do that in the public notice that we've put out to see what issues that raises, recognizing that there would be benefits to the private solution.
Mr. Hunter, let me return to you quickly. I think the RTP system has been up and running for about a year and a half. What benefits are consumers and businesses seeing as a result of that, and what can we expect in the future those benefits to then be?
Thank you, Senator. Let me start with consumers first and then go to businesses. For consumers, it really fundamentally is a safer, more efficient way to make payments. From the sender's side, they can get immediate confirmation that the recipient of that payment actually has the funds. So think about if you're paying your power bill and you're late and you want to make sure that payment gets there today, you've got immediate confirmation that you've been able to do so. We also have extensive rules in place so that consumers who use alias, so if you type in a phone number or you're using a directory of some kind, the consumer gets confirmation of the real name. So if somebody types in or fat fingers my email address, they're going to get a message back that says, did you want to send that payment to Rob Smith? It's, well, no, I didn't. So very, very important in terms of folks who are being paid and have to go to payday lenders or check cashing services. if their employers are using the RTP system to make payment, they'll have immediate access to those funds. They won't have to go to those services anymore. On the business side, also incredibly transformational. They can get payments into the hands of a supplier, for example, for real-time inventory. They don't have to rely on credit anymore, and that supplier can ship those goods with confidence that they've been paid. They can attach just about anything that you can send over the internet, an invoice, a picture showing that work's been done. So if you're a plumber and you want to convince your customer that, hey, I've installed this faucet and it works, here's the video, here's the photo. If you attach the invoice to what's called a request for payment, you can automatically associate that payment with the invoice, and you don't have to do reconciliation on the back end.
Thank you. My time's expired. I will ask some other witnesses questions for the record, and I too need to join the ranking member in a Veterans Committee. But I'll try to return, Mr. President, Mr. Chairman.
Thank you. Senator Jones.
Thank you, Mr. Chairman, and thank you for our panelists to be here. Ms. George, I'd kind of like to focus a question here on timing. Frankly, it's a little embarrassing, I think, that we're so far behind. And the Fed's payment obviously is going to be a complicated, really technical endeavor, and I believe your deadline is like 2024, which is, in technological terms, seemingly a lifetime away. It's only short if you're planning on one of the legions who are running for president, and you're already making your plans. What are you going to do? What is the Fed going to do to, have benchmarks? Do you have benchmarks already in place that you're going to be setting, that you're also going to deliver to Congress to keep us apprised of what's going on between 2024 to make sure that you're on track? Do you have those?
So we are beginning now to define what the features and design of this system is, which will guide our delivery times. And we do intend to be very transparent with how that plan comes together, making available to the public our intentions. And we will certainly be coming back with future public comment as we design that system, and that will include our delivery and planned implementation.
I take it that you really don't, and I'm not being critical, but the benchmarks haven't been set yet. You haven't set that timeline just yet, but you plan on doing that sometime after the comments within the next, 6 months, maybe?
We're working on that immediately. So
Okay.
we're beginning that phase even now, and as the comment period ends in November, we will be compiling the input that we get from the industry on how that system should look. That will inform our delivery.
All right, fine, thank you. For the panel, anybody that can answer this, we've obviously seen these kind of payment systems in other countries that have been up and running, and there's been the good, the bad, the ugly, I assume, with these. What lessons are we learning from examining those? What lessons are we taking that we can incorporate? What lessons are we learning where mistakes are made, mistakes that we want to avoid? And I'll just kind of open that up to the panel.
So I'd be happy to start that core to this work we've been doing has been looking at what other countries have done and their experiences, and we have learned from those. One thing that makes it challenging to compare for us is we have a very complex and diverse financial system. Some countries have a smaller number of institutions, and so the issues have varied. I think one thing we have taken away from this is the importance of getting input from the financial institutions themselves to understand their ability to adopt the technology, to connect to it, and to think about security around that. And those have been two areas of our focus throughout this work.
Okay. Mr. Hunter?
Yes, Senator. So we've had extensive dialogue with the payment system operators of real-time payments around the globe. One of the one of the benefits of coming late to the market actually is the ability to learn from other countries and their experience. The design and operation of our payment system is absolutely informed by lessons learned around the globe. One of the things that you'll see in our payment system is that it's a credit push system only, and let me explain what that means. There are no debit pulls, so if somebody gets a hold of your account credentials, sometimes they can try to defeat bank fraud systems and draw money out of your account. With the RTP system, the only way that you can send a payment is you have to authenticate into your banking platform, and you have to affirmatively tell the bank once you've been authenticated by the bank that you want to push money out to somebody else, so nobody can pull money out of your account. We've incorporated what's called ISO 20022 messaging. That's a little bit technical, but it's a global messaging standard. That at some point in time in the future, if we want to make, connect these real-time payment systems around the globe, it's a messaging standard that allows us to try to do that. Also, the way that we settle, in terms of the settlement account that we use at the Federal Reserve Bank of New York, and the pre-funding of that account eliminates credit risk from any institution. So to Ms. Baer's point, if an institution fails to fund that account, their payments don't flow. There is absolutely no credit risk to the system or any other financial institution as the result of the failure of any bank.
All right. Anybody else want to take a shot at that or respond?
I would just use an example of our small bank. We have leveraged a real-time payment over the SPAY network in Mexico. So I would, where a family member could arrange for a payment in Mexico from having lunch in Solon, Iowa, from a mobile device to an ATM withdrawal in real time. And so we learned that things are possible, and those funds are pre-funded in Mexico, so there's no credit risk. But it would be much better if we could link up our real-time capability on this side of the border.
Yes, sir.
The British system, which is often treated as a model of a early fast payment system, offers an interesting example of the challenges involved when you don't have central bank settlement services that are working on weekends. And here that's a challenge for real-time payments. What that means is that they can have transactions real-time all weekend, but they don't actually finally settle up until the CHAPS system, which is their equivalent to Fedwire, is open again on Monday. Now that means that banks that are releasing funds are made available instantly, but there's credit risk assumed. The way they solve that problem in England is through something called the liquidity and liquidity and loan sharing agreement, and all the banks contribute to a collateral to a fund, so that if any bank were to fail over the weekend, there's this fund that they can draw on. In the U.S., you couldn't do that with all the banks involved. You couldn't possibly get them all on an agreement like this, and that's a reason why 24/7 settlement on Fedwire really is important to avoid risk. In our case, what the Fed would do if it doesn't have those facilities for Fedwire with its FedNow system, it would incur the risk, which means we would incur the risk of these overdrafts that essentially would be taking place sometimes for long weekends.
Thank you. Senator Toomey.
Thank you, Mr. Chairman, and thank you to the witnesses. I just want to see if we can get a little bit more clarity about something that's come up. Mr. Hunter, my understanding is that the RTP has made an explicit commitment to provide flat fees on the transactions. As I understand it, that means regardless of the size of the transaction, the volume of the transaction, the size of the institution, all transactions would be treated the same, with one caveat, and that caveat is if the Fed operates a parallel system and starts to offer a discriminatory pricing structure, that the RTP may have to move in that direction under that. Is that about right?
That's correct, Senator.
Okay.
It's similar to what happened in the ACH.
Okay. So, Ms. George, let me ask you a question. Has the Fed made an explicit commitment that its system will guaranteed offer only a flat fee fee structure?
We are in the process of designing the system. We have not identified the pricing that will be associated with it, although once we do, we will make that public when that's decided. I would just say on the issue of pricing, volume pricing is common in the marketplace today, and it is often a way to take high fixed cost and make sure that you are able to maintain the adequacy of a system. And that pricing today has allowed for market share to expand with private sector operators and has been viewed as being a fair pricing structure through numerous reviews.
Thanks. But this is very interesting because what we have is the existing system is committing to not introducing a discriminatory pricing mechanism. The Fed is not making that commitment at this point. In fact, our representative from the Fed is observing that sometimes there are benefits in having pricing discrimination, which I acknowledge that's entirely possible. But for those who are concerned about which of these two is going to have discriminatory pricing, it's a little bit ironic. It's the RTP that is committed not to doing so. Another concern that I have is interoperability. Mr. Hunter, I'm going to give an example that I think of, and maybe I've got this wrong, so maybe you could help me make it clear. Let's say an Allentown manufacturer has 1,000 employees, and they're scattered around the country. They inevitably have different banks that they use for their personal banking. The Allentown manufacturer has a bank that they use to process their payroll. And the Allentown manufacturer would like to be able to deliver payroll in real time so that their employees get the money instantaneously when it's available. If some of the employees use banks that are part of a Fed system while the Allentown manufacturer has a bank that's plugged into the RPT system, and the two systems are not interoperable, is it still possible for everybody to get their paycheck in real time, on time? Does the system, or does that create a problem?
So it's certainly not easy, Senator. What the manufacturer would have to do is they would have to work through two different banks that would have to format, and it would have to format that payroll according to the specifications of either system. So it will have to work through a FedNow bank to reach the endpoints on FedNow and their customers, and it will have to work through an RTP bank to reach the endpoints on that system, those banks and their customers. So it creates a lot of inefficiency and probably added expense.
Yeah, added cost, added inefficiency to have a second bank playing this role. One of the things I hear from time to time is that the RTP has not achieved ubiquity yet. With the likelihood that there will be a Fed-run alternative in the not-too-distant future, could that be contributing to the reason that some banks are holding back and participating with the RTP system?
So, Senator, we certainly saw a chilling effect of the original Fed proposal, which came out 11 months after we launched. So I think the initial reaction to that was, we don't know what the Fed's going to be doing. We need to wait and figure that out. Since the Fed has come out with the FedNow proposal and indicated that they won't be in the market for another 4 or 5 years, I think it's really sort of splitting the market, and it remains to be seen how financial institutions are going to react. There are certainly some financial institutions who have indicated that they don't feel that they can or should wait 4 or 5 years to bring the benefits of real-time payments to their customers. There are others who may wait.
I have one last quick question. This is for Mr. Selgin. It was back in 2013, as I understand it, that the Fed launched what they call the Strategies for Improving the U.S. Payment Systems and stood up the Faster Payment Task Force. And effectively, the Fed, it seems to me, was calling out the private sector to improve the payment infrastructure. The private sector responds, spends over $1 billion on this project, more money individually to integrate with this system, and went live in 2017. And then 2 years later, the Fed announces it's going to stand up a competitor. Given that sequence of events, do you think that has a chilling effect on the private sector's willingness to invest in the future and innovation, certainly in the payment space, but perhaps in other spaces as well?
I should think so, Senator. Mr. Hunter can answer better than I can, but I can't see how it could have but a chilling effect. This effort by the Clearinghouse was undertaken entirely in response to that initiative and with the Federal Reserve's blessing, and ultimately with its complete approval of the scheme that the Clearinghouse had come up with. Then only after that, and after the system was up and running, did the Fed decide it was going to compete head-on in this same payment service. I want to add, since it's relevant, that the idea that what's happening with what the clearinghouse is doing is taking over an infrastructure that belongs to the public sector. That's a complete misunderstanding of the history of payments in this country. The clearinghouse is much older than the Federal Reserve, and in many countries, not just the United States, most payments services are provided by the private sector, many of them at least, sometimes in combination with central banks, but often alone. Central banks have their specialty, which is providing cash and also the ultimate settlement services. And as I said earlier, the Fed's not doing that last job very well because it's limiting, after years of being asked to do otherwise, still limiting the availability of final settlement services. And by doing that, and this is extremely important, it is not the case that you need fast payments in the sense of instantaneous to solve the problem of it taking days for workers to have their checks clear, etc. That problem can be solved just by making the existing Fed settlement, wholesale settlement systems 24/7, 365. The plan that would solve that problem that the Fed is now pursuing will take 5 years. That's all those people waiting for those checks to clear or those payments to clear for that long, for at least that many years, except to the extent that they can turn to RTP. And that shouldn't be the case. That's a terrible dereliction of the Federal Reserve's duties to the public.
Thank you, Mr. Chairman.
Senator Cortez Masto.
Thank you, Mr. Chairman, and thank you all for being here this morning. President George, let me start with you. I want to follow up on the questions that Senator Brown had asked. Do you think it's important to consider the possibility that the Fed would have to bail out one or more of the TCH banks if they were the only real-time payment system?
I think our experience is that we do not, for the smooth functioning of the U.S. payment system, want a single point of failure. And history has shown during times of stress that having the central bank as a provider of payments has served the country well.
Okay. And so, and as we talk about cost recovery, because that's part of the conversation as well, and because of your concern, because you don't want that single point of failure, should that factor into the Fed's cost recovery estimate?
It will factor into any cost of our system is required under the Monetary Control Act to be fully recovered, and we intend to do that with FedNow.
Thank you. And so, Ms. Baer, Chair Baer, can you add your thoughts on the potential risk of a bailout in the conversation we're having today?
Yes, so I think, as President George said, you have a single point of failure if you have just one system. And payments is kind of important. You disrupt payments, you've got a catastrophic situation with commercial activity and consumer activity as well. It's not clear to me that the RTP system is untested. They've designed it to prevent credit risk. I give them that. But they maintain a centralized ledger, and we've got to have confidence that centralized ledger will prevent negative balances in their joint account. It is possible, I think everybody acknowledges, it is possible for a large bank to lose the capacity to continue to fund the joint account. So maybe the other banks participating in the joint account are still okay. But my question was what happens to the customers of that bank that are using it? So I think there are a lot of unanswered questions about how resilient it will be during a crisis. And so nobody's saying we shouldn't have RTP. Good. I'm glad we have RTP, but we should have another system too. Competition is always good, and the Fed is much better equipped to continue to function, and its track record is such, to operate in good times and bad under extremely stressed conditions. And if we just have this one system, if it does disrupt, the Fed's going to have to come in anyway with a much messier and inefficient way of trying to stabilize the system again.
Right. Thank you. Well, while I have you here, we've been having conversations here in this committee on this issue. And Chair Baer, in your testimony, you urged the Fed to fully explore the use of digital currency, including cryptocurrency based on a distributed ledger technology and effectuating real-time settlement between banks. Why do you think the Fed should consider developing a central bank digital currency that could eventually be used by members of the public to transfer money directly between?
Well, it's still maturing technology, but it's maturing rapidly. And it is clear, having a distributed ledger that all banks would have access to, that you don't need an intermediary, you don't need a TCH, you don't need a centralized ledger and that single point of failure. The digital transfer is directly from the sending bank to the recipient bank. So yes, I think it needs to be explored. It's still maturing. No other central banks have done it, but a lot of other central banks are looking at it, and I hope that is something that they will continue to explore as they build this system. It also helps address some of the interoperability issues that we've been discussing earlier, but I would like to just, Mr. Hunter has insisted that RTP cannot be interoperable, and I would just note that kind of reinforces their monopoly position if his view is that their system, real-time payments, is somehow incompatible with interoperability. And interoperability is a two-way street. And I would hope that TCH would sit down with the Fed and try to agree on common standards and figure out a way that these systems can most efficiently interact. If he wants to say, no, nobody else can play, then, if you don't have the Fed, then that just solidifies their monopoly position as a single provider of this crucial function.
Thank you. And President George, to what extent is digital currency and the future of it being, are you considering that as you move forward with this payment
Federal
system?
Reserve and other central banks are looking closely at how this evolving technology is affecting the financial system and will continue to do so.
Are you watching what's going on with Libra?
We are watching that also. So the full range from distributed ledger to digital currencies very much under study as we see how those unfold.
Thank you. Thank you all again for being here.
Thank you, Senator Tillis.
Thank you, Mr. Chairman, for holding this hearing, and thank you all for being here. Mr. Steen, I want to let you know that I joined with a group of Republicans and Democrats that recognized that small banks and community banks have regulatory burdens on them that we thought were inappropriate. That's why we joined together against the objections of the ranking member of this committee to provide you all with regulatory relief. This may be an issue where you and I want the same ends, but maybe achieve it through a different means, and that's really what I want to talk about. Ms. Blair, you mentioned in your opening statement that this was a measured and deliberative approach to decide to come up with a payment system. I understand that a part of that was engaging an outside firm to try and figure out what's wrong with RTP and the clearinghouse, and that the conclusion that those outside consultants made was that most of it's working right, some of it needed to be addressed. And so I'm wondering why we seem to be going with this a la prima approach versus trying to address some of the legitimate concerns Mr. Steen and others would have with using RTP. And Mr. Hunter, Ms. Blair also mentioned in her opening statements about the private sector approach could subject in future crisis, subject us to bailouts. So under what scenario would the clearinghouse or RTP be in a position to where it would need to get I understand the investing. I know the banks that stood this up, and I understand them. But I'm trying to understand under what scenario. I understand that you performed very well during the crisis. I don't think that you required a bailout. I don't think that there were any outages. I do believe that Fedwire has experienced some outages and does have some resiliency challenges that they need to deal with and availability. But under what scenario would you actually be subject to a bailout request?
Senator, there is no circumstance where we would be subject to a bailout request. I mean, we have detailed processes in place to deal with banks that are on our systems that have been worked out with the FDIC for resolution of those banks. And Ms. Baer may not be aware of those given her position at the FDIC, but we work very, very closely on bank resolutions. And there is no risk to the system. They're architected in such a way that that just doesn't happen. So those circumstances, Senator, simply do not exist.
I had another question, really going back to the measured and deliberative approach. It's my understanding, and Ms. George and Mr. Hunter, maybe you can illuminate, but under the Bank Service Company Act of 1999, provides fairly significant or broad authority. But for some reason, it appears as though the Fed does not think that it has the authority to engage with the private sector, to engage with the clearinghouse or RTP to address some of the concerns you may have, maybe concerns that Mr. Steen has. So why wouldn't a part of that deliberative approach be a discussion about expanding the regulatory perimeter so that you could address those concerns with a private sector solution? And I'll start with you, Ms. George.
Thank you, Senator. The The Board of Governors explored this issue and highlights it in the Federal Register notice that they believe those authorities were not adequate, and clearly the Federal Reserve.
Okay, but why not a discussion about expanding the authorities to the extent that you could address what we're now thinking about, a major undertaking that will take 5 to 7 years? I'm a technology person. I think it's probably +5, closer to 7, and a lot of cost. So why wouldn't there have been a discussion of, if you've concluded that you do not have sufficient regulatory authority, to come back and come to Congress and ask what they may be?
I think because our experience under our existing authorities of Congress of providing these services as an operator have been so effective throughout history that it led us to rely on those existing authorities and provide the competition that has served the country well. And that was the conclusion, I think, that you see in the Board of Governors analysis.
Mr. Hunter.
Senator, thank you for the question. The Federal Reserve, not only the Federal Reserve, but frankly the OCC and the FDIC have broad regulatory authority over the clearinghouse. Basically, any regulatory authority they have over a bank that they supervise is the same regulatory authority that they have over the clearinghouse. And I quote extensively from the Bank Service Company Act in my written testimony, and I would direct you to those statements. But in addition to that, as Congress has enacted in this country, we have detailed competition laws that we are subject to, and the Federal Reserve is not, but the private sector is subject to, and the Department of Justice stands ready to enforce. So when you talk about anything related to pricing or monopoly power or acting in an anti-competitive way, which the Federal Reserve speculates that the private sector could potentially do at some point in time, those are illegal activities under the laws of this country. We have never engaged in those activities, but if we ever did, or if any other private sector ever did, there are laws in this country that protect against that.
Well, I have a number of questions. I, too, have to go to the Veterans Committee. This is very important to me because I think, in some respects, I view the current Fed proposal as a $100 saddle on a $10 horse. I think that there are some things that we may be able to do to address some of the concerns and make sure community banks are treated properly to avoid potential future discriminatory practices on pricing, resiliency questions, interoperability questions, the kinds of things that you're going to have to get into. So I will be submitting a number of questions for the record for you all, and I appreciate you all being here.
Senator Van Hollen.
Thank you, Mr. Chairman. Thank all of you for your testimony today. Moving as fast as possible to real-time payments has been a priority for mine. I've talked to lots of witnesses that have come before this committee on this matter because the lack of a real-time payment system is costing millions of Americans billions of dollars every year. So, President George, I commend you for your leadership in this issue. I know it's an issue you've thought about a lot, and you've been very thoughtful in developing these proposals. I've listened to the testimony. A lot of ground has been covered. I do think the fundamental question gets down to this issue of competition. And I realize that the Clearinghouse says it welcomes competition on the one hand, but on the other hand, all the testimony here today is let's not have a separate FedNow system. And it seems to me that keeping that monopoly position in the hands of 15 biggest banks is not necessarily in the long run the best deal for consumers. And a little competition is a good thing in my view. Mr. Steen, you represent lots of financial institutions, and you're obviously looking out for your consumers and your customers here, and you've expressed a real fear in your testimony and earlier statements about handing over this kind of monopoly power to this kind of monopoly. And you actually raised before this hearing the same issue that Senator Toomey raised here, which is when the Fed said it might get into this space, the Clearinghouse then said, well, you know, we made this promise about not engaging in, you know, not changing pricing in a discriminatory way, but, you know, we're going to have to reconsider that, which in fact, in my view, just underscored the need to have an alternative here. So can you're someone who's working this issue on the ground every day. If you can just, you know, how would you explain to one of your customers coming into your bank why you think it's important for the FedNow system to be put into operation.
Well, Senator, thank you. My customers are looking to us to provide them the fastest payment possible, and I need to ride that train. And the one constant in my career has been the Federal Reserve. And from a pricing standpoint, they've demonstrated when technology improves, they can lower my cost. And they explain that to us, and we understand it. So I just know that we cannot lose that. And I know accessibility to every small financial institution is just so critical, and we're one of those. And so I'm absolutely confident the Fed is doing the right thing, and we've been asking them to do it. I was on the task force. I was on a steering committee. I was on a director work group, and I've been pounding the table for them to do this all the way along the way. And they are, and I'm confident it will move along very quickly. I saw what they did, Check 21, and how fast that revolution took place, and I was part of that. And so I'm confident we can accomplish this.
Thank you. And I would point out, as the chairman knows, it was a 4-1 vote on the board of the Federal Reserve, right? Ms. Baer, you've been in the middle of this during really tough times in terms of financial institutions in our country. And in response to a question, you just pointed out that this suggestion that we could not make these systems interoperable was kind of like the statement on monopoly and discriminatory pricing. Another example, actually, of why it's important to have an alternative, right? Because otherwise, the system with monopoly power can use that leverage in certain ways. So can you expand upon your concerns there?
Because I think it's important to understand we're talking about interbank settlement. So there are a lot of banks working with financial technology companies trying to come up with new innovative ways to help people send and manage payments that are customer facing, but you still have the problem of getting the money from one bank to another. And so if you have a monopoly provider for that piece of it, all these other innovators that are working on customer interfacing services and applications will have to go to that single provider. This is why, I know the big banks love this, but pretty much nobody else does. There's not trust. The small banks don't trust them. The financial technology companies don't trust them because this will be giving them monopoly pricing power. And they may say today, we won't do it. We'll be fair and equitable, but the Fed has no authority to regulate rates. I also agree, though, with President George that the best way to address this is through competition and giving smaller institutions, giving financial technology innovators working with those institutions an alternative, giving them two places to work with, to deal with, to support their innovations. So, and I would also say that the problem of trust is one of the reasons why I don't think RTP has gotten traction. If there was trust, if it was a great service, who would care whether the Fed's going to come in anyway? People would be jumping for it, but that's not happening. The public comment process has overwhelmingly said that pretty much everybody outside the big banks who own TCH want an alternative system.
Thank you. Look, I think the history shows that competition actually spurs innovation, not stifles innovation. Thank you, Mr. Chairman.
Thank you. Senator Kennedy.
Thank you, Mr. Chairman. This debate, and I haven't made up my mind on this, this debate reminds me a lot of the debate we're having in health care about whether the United States government should set up its own health insurance program to compete with the private sector. That's just an observation. Second observation, Mr. Steen, I have great respect for the Fed, and I would remind you, though, that it was the Fed, or at least people influencing the Fed, who decided in 2008 that the community banks were just as responsible as the too big to fail banks for the meltdown, which was patently untrue, and some people around here decided to try to regulate you and your colleagues after death, which I think hurt the banking system. So I'd just caution you up here in Washington, don't trust anybody too much. President George, let me ask you this, and this is honestly a question. I don't mean the question to suggest an answer. tell me what's wrong with RTP. Right? Is it not working? Can it not work? What's your concern?
So I have no insight to the functioning of RTP, but we have encouraged private sector innovation in this space, and for many years.
Can I stop you a second? If you have no insight into RTP, then why do you want to set up something to compete with it?
Because our interest in making sure, under our public policy goals, that access is broadly achieved for this service extends to some 10,000 institutions in this country, and we have an existing network, reach, and relationship with those institutions.
I get that, and I'm sorry to interrupt you, but I don't know what I want to understand. I mean, doesn't the Fed have enough to do? It would just seem to me that if RTP can work, if you want to compete with it, that may be the right approach. But what I'm trying to understand is why.
Our interest.
I understand you have the power to do it, but why does it make sense to spend taxpayer money for the RTP, for the Fed to go set up a competitor for something that may be working? Unless it isn't. If it isn't working, tell me.
The information we took from the private sector task force came to the Fed and said we need the Fed to get into providing real-time payments with the private sector.
Why?
The reason was to achieve broad reach. We have many community banks in this country that are in rural and remote areas that would not otherwise be profitable places to provide services. They need these services for their communities. They need to be able to attach to systems that might otherwise be out of their reach.
May I stop you a minute? Because I don't mind not trying to be rude. Our time goes so fast.
Yes, sir.
So the Fed has the power to punish banks the rest of their natural lives. You and I both know that. I know you don't put it in those terms, and I'm not suggesting anything untoward. But so why don't you turn to RTP and say, look, here's some changes we would like to respectfully ask you to make. You don't have to make them, but our advice is you should. They're not going to ignore you, are they?
I think our experience is operating alongside the private sector has produced the best outcomes for the payment system.
Yeah, but my question is, if you see a way to improve, I'm trying to understand, if you see a way to improve RTP, why don't you just sit down with them and say, folks, here we want you to extend your reach. We want you to give us jurisdiction over the prices you're going to charge, and we want to make sure that you make your service available to everybody. Boom, problem solved. Then you save a bunch of time and money, and you don't have to set up a competing system because taxpayers are going to pay for what you're going to set up. And I know you have enough to do.
We certainly have enough to do, and we are intent on fulfilling our public policy authorities as Congress has granted us in this arena, which is to make sure that that system is accessible, that it's provided equitably, and that it is safe. And we will continue to operate alongside the private sector in achieving those outcomes for the public.
Okay. Can I ask one more, Mr. Chairman? Since it's just you. Oh, I'm sorry. I don't want to cut into Senator Smith's time. But I think Ms. Blair is raising her hand here.
Well, I did. I just wanted to strongly support what President George said and indicate that I get what you're saying about, so first of all, they don't have regulatory authority. I think so. There is no direct authority to do rate regulation and access controls and all the kinds of things.
Yeah, but they're not.
You would find with the public utility.
In the real world. The banks aren't going to ignore the Fed if the Fed tells them to do something.
I wish that was true. But as a Republican and somebody who I consider myself market-oriented, I think competition is a much better discipline on pricing equity and efficiency and broadening customer bases than trying to prescriptively regulate this. So
that's one point of view. Another point of view is you just want to expand government.
No, I don't think that's what the Fed's, look, I've worked with the Fed for a long time, and I've criticized, other parts of the Fed. I advocated for limits on the Fed's bailout authority. They probably weren't happy with me. Chairman Crapo remembers that, and Dodd-Frank. So in other context, sure, the Fed's got a lot of power, but this is like bread and butter of what they do, and they are the only ones who can come in with an alternative parallel system because of the costs and the resources that are required to do this, if you just rely on private enterprise, there will be a single monopoly provider without the regulatory authority to impose pricing and access controls. So I do think that the Fed is absolutely, this is in the public interest to do, and it will be more efficient than just trying to regulate it with authority they don't have. And I think big banks push back quite a bit against the Fed and the FDIC, so I would not say that they always do what their regulator asks them to.
Thank you, Mr. Chairman. I'm sorry, Senator.
Senator Smith.
Thank you, Mr. Chair. And I just realized I might have accidentally taken some of your authority by ceding time to Senator Kennedy without your permission.
No problem. You're welcome.
You're on double secret probation.
I want to thank all the panelists for being here today, and I'm sorry I missed the back and forth with my colleagues because, as you no doubt heard, we have lots of committee hearings today. So I just have I'm sure the ground has been well plowed here. Let me just ask a question of President George. President George, the Fed operates several payment systems already, and I'm wondering what you've learned about fraud prevention from that experience. You know, one of the there are many upsides to real-time payments, but of course one of the possible downsides is real-time fraud. So could you just share a little bit about what you've learned about that?
So the security of the payment system is essential, and I think, as you've noted, in particular when payments are moving this quickly. So we would see, as part of our initiative, and as we did with the private sector task forces, thinking about security and what fraud mitigation standards will be important. And I think that will include education efforts, the banking system, making sure that their customers understand what role they play in that.
Thank you. Would anybody else like to comment on that fraud question?
Absolutely, Senator. So we take consumer protection very seriously. We worked closely with the CFPB in our design and establishment of the system. And we've learned a lot about fraud from our interactions with other real-time payment systems around the world. Fundamentally, the way we've architected the system is a much better, much more safe, much more secure experience for consumers and businesses because these are credit push payments only. So the consumer or the business have to actually authenticate into their banking system, and the only way that they can make a payment is to push those funds out. There are no debit pulls where if somebody gets a hold of your account information and they can defeat the fraud control systems of the bank, they can get money out of your account. So fundamentally, this is a much more safe, much more efficient, much more sound way for consumers to make payments. And if I can, Senator, I just want to say that you know, we will certainly work and to have discussions with the Fed about interoperability. I don't mean to imply to anyone that we are not concerned and wouldn't want to get there. When we talked about designing the system, we had hoped that interoperability could be achieved. We're not optimistic, but we are certainly willing to do everything possible to discuss with the Fed and try to reach that result.
Thank you. Just another question that is very specific. It was raised to me specifically from Minnesota credit unions, of which we have many, and they're very important to communities in Minnesota, is small credit unions are trying to figure out, you know, they don't have staff available 24 hours a day to monitor transactions and troubleshoot problems. And so my question to the panel is, how can small institutions prepare to handle a payment system that would be on 24 hours a day? Like, what would be the solutions, just the operability solutions for small institutions?
Senator, if I may, we have worked very, very closely with third-party service providers. And one of the things that we've recognized is that they are going to need banks like Mr. Steen's bank, other community banks. We want all of those banks to be on the RTP network because the network is only as valuable as the banks that it can reach. So third-party service providers, bankers' banks, corporate credit unions, other institutions that provide critical services, back-office services to small community banks and credit unions have been on our radar ever since we designed the system. What you have seen are large banks who handle their own technology coming onto the system to date. What you haven't seen, but is equally important and what is maturing, is the work that we've done with those third-party service providers to bring small financial institutions onto the system. They have begun to be in a position to activate those core back office systems, and they're going to start bringing on small community banks and credit unions in the next several months.
Thank you. President George, would you like to respond?
So this is a real issue for small institutions, credit unions, small banks, and we will be working carefully around standards, which I think help them in adhering to things that protect them and protect their customers.
Thank you. And just one last question. So I'm just let's say I'm just a person, which I am, and I'm trying to, and I can see that real-time payments, whether I'm a small business, that's going to be helpful to me. So can anybody explain to me what is the harm of more competition? How am I harmed as an individual if there is more competition rather than less competition in this market?
So, Senator,
Let me just ask Ms. Bayer about this.
Well, I think consumers are helped. It will result in more innovation, more competition, better pricing, wider access. I think absolutely two systems will support consumers and their ability to have a choice of real-time payment services, and for all banks of all sizes and depository institutions, including credit unions of all sizes, to be able to participate. And this is the future. We will have real-time payments, and so the challenge is to make sure everybody is included. Having these two systems is the best way to do that.
Senator, if I may,
Sorry, but I think Mr. Selgin was going to speak.
Oh, yes, I was going to say.
I'll let you.
Yes, I'm not one of those who opposes competition between the Fed and the private sector, including the clearinghouse. What I'm concerned with is that the competition has to be fair. If any of the players can cheat or can compete unfairly, to put it a little bit more mildly, that can upset the competitive process that normally leads to good results. That's why we have the antitrust division, for example, to make sure private firms don't compete. In the Fed's case, we have to there are other precautions that are needed. Some are taken already, but there are many ways in which presently the Fed can compete unfairly, and a few have been mentioned. One of them is not paying interest on reserves held in joint accounts that serve the same purpose as other reserves, not classifying, funds in those accounts as reserves. They should be classified that way. Another is by not making its essential clearing services, settlement services on Fedwire and on NSS available 24/7. That allows other non-real-time payment systems to compete more effectively by having faster payments, but not necessarily not real-time payments. And there's competition on that margin, too. So there are a lot of steps Congress can take to assure that competition is played on an even playing field, a level playing field between the Fed and the private sector. That's the key, not preventing competition.
And Senator, if I may, we are not against competition. Let me make that perfectly clear. What we are concerned about is an unlevel playing field between the private sector and the government. We are also concerned that if we can't figure out interoperability and no systems worldwide interoperate in real-time gross settlement payments like we've set up here, nobody's figured out how to do that yet. That will lead to a very suboptimal result in this country for consumers and businesses, where the participants and their customers on one system aren't going to be able to complete payments to the participants and their customers on another system.
Thank you, Mr. Chair.
Thank you, and that completes the questioning, although I'm going to ask for a brief response from all of you on an issue that Senator Cortez Masto raised. But first, let me thank you all for bringing this perspective here. We have the obvious divergence of opinions on the committee here about this issue. I find it interesting. I think Senator Kennedy probably focused on the dichotomy, or we all believe in competition. We also all talk about how we believe in not having the government be too large and having the government step in. Here what we're talking about is the government competing with the private sector, and that kind of puts an interesting twist on the competition discussion. It's and then the reverse of that is the discussion about, well, you have a monopoly if you have only one provider in the private sector. And so how do we deal with that? These are difficult questions. And as you can see, we have different perspectives on that on the committee. I encourage the Fed, as it moves forward here, which apparently it is doing, to take these kinds of considerations carefully into mind. And hopefully we'll be able to work this out. The question I want to address, however, is the one of digital currencies. As you're all aware, this committee right now is dealing with the Libra proposal from Facebook, which is only one of the more recent utilizations of blockchain technology on the internet, but in the context of creating a digital currency. And we have many examples of this technological development on the internet, Bitcoin and many others. But they raise the question, as I understand it, of whether we are moving technologically to a whole different world than the one which we spent this entire hearing discussing. And that world is digital currency related technology, which perhaps our central banks, as well as all of our financial institutions, small banks and large banks alike, credit card companies, every kind of transaction need to be more focused on. And I know that I've just asked a very huge question and asked you all to respond very briefly. And I really mean, perhaps what you could do is respond to me on this, just your thoughts about this issue in general in writing following the hearing. But am I right? Am I correct that we need to start looking at this entire transition to, or whether there really is a transition? Is this a technological change that we should consider as being transformative in the way that we deal with currency and with financial transactions? Why don't we just go down the line? Ms. George?
Yeah, thank you, Senator. It's a very important issue, I think, because it's hard to forecast where this is going. And it's one of the reasons that we study carefully what does it mean. Because one thing we know is we've invested heavily in trying to have a banking system that is sound, that serves the economy, that serves the American public. And of course, with that has come safety nets, consumer protections, thinking about access to credit, many of those things. As we look at what disruption may come to the existing framework, I think that's why it's important we study to see how will any of those safeguards be disrupted, how will they apply in a new world with different technologies. And I think at this stage requires us to be very cautious and look carefully to make sure that we gain the benefits of innovation, gain the benefits that can come from new technological approaches without undermining, I think, what has been hard-earned and won safeties for the economy.
Thank you. Anybody else want to comment?
Senator, Mr. Chairman, I appreciate the question. We certainly share Ms. Baer's and other folks' concern about unregulated and largely unsupervised social media companies getting into setting up digital currencies that could threaten the prominence and the value of the U.S. dollar. That said, we've looked at digital currencies or blockchain as a technology throughout its development and deployment across the U.S. And it really is not terribly fit for purpose when you think about using it as a payment system. It takes an enormous amount of processing power. It's relatively slow. It doesn't sort of process the number of transactions that you need to process and the speed and the volume that you need to really serve the country. I think it's one of the reasons why, I mean, this concept has been around for a long time. You don't really see it being deployed and used a lot for payment systems. It's sort of deployed around the edges. It's not really caught on. Blockchain is a great solution for the Register of Deeds office, where you want records that go back until the beginning of time and you can create lots of information. But it's not terribly fit for purpose in the payment space.
All right. Anyone else?
I do have some thoughts on that, and I would like to submit them to.
I'd appreciate that, yeah.
No, I appreciate the question. I think you're right to focus on it. And something like Facebook's Libra would take payments completely outside of the banking system. We would lose substantial control. So whether it's technologically feasible or not, I mean, Facebook's a pretty smart company and has spent a lot of time on it. They seem to think it would. I think the lack of any kind of regulatory structure around that, I think, I encourage the committee to continue looking at that, because the last thing we want is to lose control of our fiat currency, which is why I think ultimately central banks, including the Fed, need to get ahead of this technology and capture it themselves so that they cannot be disrupted by a large non-bank entity like a Facebook.
Yes, I would add, Senator, that we've all been talking about the benefits of competition in the payment system, and these digital currencies are part of that potential competition. And they're a particularly important part because they represent some very intriguing innovations that have not come from government, have come from the private sector. We don't know the full potential benefits that may be had from these technologies ultimately. Mr. Hunter is quite correct that so far they have not been particularly useful for payments, although people think of them as being used in that connection. They have a lot of disadvantages. But I think it's desirable that they too be part of the process. As for central banks providing digital currencies themselves, well, it must be said that the paper notes that the Federal Reserve issues are the horse and buggies of the modern payment system, and that digital substitutes for these could well be an improvement. But there, once again, we would want the Fed to be competing with private sector providers and not monopolizing the provision of these substitutes. And there's no reason why you could not have some private digital monies that are dollar-based, and we have things that are close to that so far. The main thing is that competition has to be allowed to work itself out amongst parties participating on a level playing field.
Well, thank you, and I appreciate these insights. I would welcome any further insights you'd like to share with me on this issue. It seems to me that this is, unless it becomes clear that it's such a cumbersome innovation that it just can't be utilized in the payments system or in the currency systems of the world, it seems to me that this could be truly a disruptive influence and I don't say that in a negative sense. I mean in the context of its impact on literally currency transactions of all types in the world. And some of those impacts could be very positive impacts, some could be very dangerous impacts. You think of things from eliminating cost to consumer in the system to expanding opportunity for money laundering. And all kinds of other different potential impacts of the expansion of this new type of innovation. So I'd love your thoughts on it as we move forward. This is obviously another issue that the committee is currently struggling with. With that, I want to conclude this hearing. Again, I thank you for all of your input and welcome your further input on this. For senators who wish to submit questions for the record, those questions are due to the committee by Wednesday, October 2nd. I'll ask the witnesses if you would all respond to those questions as promptly as you can. We would appreciate it. And again, thank you for being here. This hearing is adjourned.